Hello investors, welcome to Simpli Stocks. About a year ago, when tariffs were announced, I made a video on contra investing where I covered Garware Hi-Tech in depth. Since then, I have covered it 2 or 3 times more. For Garware, my view was that even though US exporters had corrected due to tariffs and their valuations had become very cheap, among them those with differentiated moated business models which have a good cash balance, whose balance sheet is very strong, whose fundamentals are good, and where the product offering is differentiated, or basically they have some unique product or mode, those businesses will be able to cross the uncertainty of tariffs. Garware has done very well since then because of all these factors, and recent March quarter results that have just come out, they were also very good. In their con call, their management commentary regarding the future is also very 10 on 10. So today I have brought a dedicated video for you on Garware Hi-Tech. Even though it has done quite well recently, I personally feel that from both a valuation and growth point of view, both perspectives, there is still a lot of scope in this business. Therefore, without any delay, let's get quickly started. Now, Garware Hi-Tech is a small cap business. To explain to you in a very simple language, they are in the business of making different types of plastic films or sheets. Like they make automotive sun control film and paint protection films or PPF for cars. These films are applied on top of premium luxury cars. They provide protection from scratches and sunlight and also increase the life of the paint. Similarly, they also go on windshield and sunroofs of cars. And you will be surprised to know that Garware was the first company to manufacture PPFs in India. Previously, many people did not even know that a product like PPF existed for cars. But Garware came and built the market around it. Similarly, they also manufacture architectural sun control films or SCS. These are used in large glass buildings and other structures. Like architectural SCFs are installed in airports, malls, hospitals, luxury homes, and railway stations as well. This is their high margin specialty product segment. Apart from this, they also make shrink film, packaging and lidding film, etc. for the packaging sector, which are low margin commodity products. Here also, Garware is a big player. Garware has about 70% market share in this segment, or we can say it is a monopoly. But although since the margin profile is low here, so from an analysis point of view, it is not much of a significance. Now, these are their three different product segments. And product wise, approx 50% of their sales come from sun control films, about 25% from PPS or paint protection films, and approximately 25% from low margin industrial and packaging films. In their business, interestingly, the contribution of D2C business or direct to customer sales has grown to 10 to 15%, where they are bringing sales through their own stores, experience centers, and also website. And that is good. We will come back to this slide later. But for now, let us move forward. And geography wise, you see 25 to 30% of their sales come from India. The remaining 70 to 75% come from other countries where the US is the largest market with 40 to 45% sales contribution. And because of this, the tariffs had a direct impact on their business. However, after tariffs, MENA or Middle East and North Africa region emerged as a good market for them. And we will talk more about this as well later. Now, let us talk about the moats in this business and the near-term triggers one by one. Then we will look at the results, valuation. But let us first start with the moat and how Garware has done very well despite the tariffs. So Garware has spent years doing R&D, which has helped them to develop product expertise. Garware has its own patents and a technology moat, and they even have their own self-designed machinery through which they are able to produce films with premium nano dispersion technology. And there are very few companies in the world that are able to make such products. This product expertise helps them to maintain superior pricing and margins. That is the moat. Now, Garware was heavily dependent on the US market earlier, but when tariffs were imposed, they started expanding their distribution in MENA to hedge themselves. And this proved to be a very sensible decision. The Middle East gets a lot of sunlight and heat also, and there is no wind. So MENA is becoming a very big market for SCFs. Their sales are growing very fast, and during the con call, management also highlighted that the war has had not any major impact on their Middle East exports. The company has found new supply routes through which they are able to supply the products easily. So you can clearly see how a crisis unlocked more business for Garware. And now that tariffs have reduced, both markets are bringing the growth. Plus, discussions are also going on regarding tariff refunds. And whenever those refunds come through, that will also give a 1 quarter earnings boost to exporters like Garware that were impacted by tariffs. And the Middle East was one diversification step. Besides this, they also started working aggressively on their D2C business. This was the second diversification attempt. Like I was telling you that they were bringing sales through their own stores, experience centers, and website. Its contribution has become 10 to 15%, and margins here are 25 to 30% better. So both MENA and D2C segments are doing well and growing fast for the business. They already had a product moat, but until now, most of the sales used to come through private labels. But now Garware is putting a lot of focus on building the Garware name as a brand, and this D2C attempt also. So we have a business in front of us that has technology and R&D moat. And now coming out of a crisis, many growth areas or avenues or segments have also been unlocked for them. Now a humble request, just before moving forward, if you are liking this video so far, do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks, where we bring multiple such videos every week. Honestly, your likes and subscribes are our only motivation so that we keep bringing such high quality research to you for free. So do like this video, and yes, also subscribe to our channel. Now let us get back to our discussion, and now we will talk about their results, margin profile, and valuation. Here you will see that for Garware, Q1 and Q2 went well. Since tariffs were going to be imposed, their dealers and distributors stocked up on a lot of goods. But during Q3, or the months of October to December, the full pressure of tariffs was felt on the company. But Garware managed the tariffs very well. To counter the tariffs, they negotiated with their dealers in the US, suggesting that the dealers bear a little bit of cost increase and the company would bear a little too, so that price would not increase for the end customers, so that they don't lose the customers. Apart from this, they also managed their costing and saved some margins over there. But yes, in Q3, the impact of tariffs was visible on both sales and profits. The EBITDA margin came down from 23 to 25% range to the 18 to 20% range. So overall, still Garware gave quite good results despite the tariffs, and I will tell you the reason for this. So Q3 is a weak quarter for them as the winter season arrives in the USA. And during this time, the demand for sun control films also decreases. Besides, if you compare their Q3 FY26 with the previous year, sales barely fell by 8 CR. Or we can say tariffs started getting applied to the company when their weak season started in the USA. And the main demand for SCFs and PPFs starts coming from February and March. So as soon as Garware entered its peak season, the tariffs were reduced. That is why going forward, we will see quite a lot of pricing comfort in their numbers due to the reduction of tariffs. And to some extent, it is also visible in Q4 as well. Like if you see here, in Q4, the business has come back on track. The EBITDA margin, which was 22% last year, has been 26.2% in this Q4. And mind you, Q4 has been the best quarter for Garware so far. And even on a full year basis, you will be able to notice how Garware has managed this entire year very well, as we have seen no decline in their sales and profits despite the tariffs. Their management has talked about growing sales at 15 to 20% CAGR in the medium term. With the EBITDA margin, they are saying that it can stay in that 20 to 25% range. For this year or FY27, they are targeting about 2,500 crore rupees in sales, which although works out to be slightly lower growth of 18%, but I think that they will be able to do easily better than this. And because I'll tell you the reason. So Garware has seen approx 600 crore rupees in sales in these months of January to March alone. So Q1 and Q2 are anyways very strong quarters. So I think it should not be that difficult to beat this guidance. Plus, another trigger is that cheap products are imported in India from Korea and China. And there are discussions going on that anti-dumping duty might get imposed on them, these cheap imports from Korea and China. And that is also a trigger which can play out in the medium term, and it can either lead to higher sales or also margin expansion. And you know what? I have seen this in many analysts that they take the management guidance as the final word, or they take it for granted. And you should understand that guidance is just an estimate. It is our job as analysts to figure out how much potential there is in the business. Anyways, let us come back to our discussion. So even if sales go up by just 18%, I feel there is still a trigger for margin expansion. In FY26, margins were impacted due to tariffs, but they can do 25% EBITDA margin in FY27. And based on this, your estimated profit for this year comes out to about 425 crore rupees. And this works out to be 25 to 26% year-on-year growth. And then at this estimated net profit, your 1-year forward PE comes out to about 28, which is quite a good valuation for this business. And they currently have a 4,200 LSF SCF capacity on which they are now doing a capacity expansion. This capex of theirs will go live next year, which will increase their capacity by 30%. And another interesting thing here is that their lines are fungible, meaning they can manufacture PPFs on the SCF lines as well. So that is quite an interesting thing. And for this year, they have sufficient capacity. This capex will bring them growth next year. And apart from all this, their return ratios are also very strong. Like in FY25, their ROCE was 27%. The company is debt-free. The balance sheet is very strong. All the capex is being funded through internal accruals, or let us say their own past profits. And this is not a small business. Like their market cap right now is about 12,000 crore rupees. Plus, they have a moat of product and also clear roadmap for growing their sales and profits consistently. So you can look into this business, and I personally put a lot of emphasis on moated differentiated business models. Like if your business is unique, or let us say it has a strategic advantage, then its margins will obviously stay good, and competition doesn't make that much of a difference. And over time, your business will also be able to command a premium valuation. So Garware Hi-Tech is a very interesting, very attractive business, and you can study it once independently. And I hope I have made you understand their business model, moat, products very well in very simple language. And if you like this video, then please do give me a thumbs up. Also, you can subscribe to our channel Simpli Stocks as well. Through Simpli Stocks, our purpose only is to simplify such unique hidden business models for retail investors, so that you also get the same type of research that mutual funds and ACE investors have. So if you support us by liking this video and yes, also subscribing to our channel, I'll be able to bring more such videos for you every week. Rest, I'll see you in the next video. Happy investing.